Federal Reserve Chairman Jerome Powell was testifying before Congress today during his confirmation hearing, and he reiterated during these 2.5 boring hours that the Federal Reserve is committed to stopping inflation because of the unprecedented, the record-breaking inflation that we've been seeing. They're going to be stopping their asset purchases, raising rates, and then even removing assets off their balance sheet, letting these assets run off. So today, in this video, we are going to look at what happened the last time the Federal Reserve took this course of action, because as is always the case, it's happened before. Ready? Let's dive in. First things first, let's look at a couple of things that Federal Reserve Chairman Jerome Powell said in his confirmation hearing. Right here, he says, as we move through this year, if things develop as expected, we will be normalizing policy, which means they're going to be ending their asset purchases in March. So he says normalize because in a normal situation, the Federal Reserve does not need to continue to inject additional cash, money into an economy. Instead, they just let the economy run as is. And so as they purchase assets, what you're doing, you're removing assets from the economy, things like mortgage-backed securities and treasuries, and in their place, you're giving cash. Then that cash can go and, it can be used for other things by the financial institutions that the Federal Reserve purchases those assets from. So he says we're going to be going back to normal policy where we're not adding additional cash. And at some point, perhaps later this year, during 2022, we will start to allow the balance sheet to run off, and that's just the road to normalizing policy. Now, that's important. We are going to come back to this balance sheet running off, what that means, what that looks like, because that is important. Now, although much probably won't come from it, it is a good thing that most of the questions during the 2.5-hour confirmation hearing centered on inflation from both sides of the aisle, because inflation is running at a 40-year high. And so this is where there's a lot of political pressure right now, because that is the most pain. Those are the pain points that most Americans are feeling right now. And so that is what politicians are concerned about. They want to make sure they're at least giving the appearance of trying to do something about the things that are bothering their constituents. And so most of the questions came about inflation. The reason I say probably nothing will come of it is because inflation is always and everywhere a monetary phenomenon. It is produced by easy credit. It is produced by an expansionary monetary policy where the money supply expands rapidly. Really, technically, it's when the money supply expands at a faster pace than productivity or growth. And that's not to say that you can zero inflation is something to be sought, where you have the money supply grow at a pace where it kind of equals growth so that prices are stable. Even stable prices are theft, because stable prices rob the consumer, rob the individual of the deflation they would have otherwise. If you had a set supply of money that did not grow, then all the growth that you have, every time you have an increase in wealth, an increase in productivity, that shows up in prices going down, because you get more stuff over time, but the same amount of money used to purchase the stuff. That means money becomes more valuable compared to the stuff. That means money becomes more scarce compared to all the stuff, which means stuff gets cheaper. It takes less money to get the stuff. And so when you have growth, an increase in wealth, an increase in productivity with a fixed money supply, prices go down over time. It's the exact opposite of what we experience when you have an increase in the amount of money beyond the productivity growth, beyond the wealth growth. You have prices increase over time because money becomes more abundant compared to all the stuff. It's easier to get your hands on money compared to getting your hands on stuff, which means it takes more money to get the stuff. And so it's exactly the opposite. And so stable prices even are not something to be sought. They are even stable prices are robbing people of the deflation they would have otherwise. And so the fact that the Federal Reserve is 100% at the root of inflation means that it really does not matter. Politicians are saying, hey, what are you going to do about inflation? Because when push comes to shove, the most pain will be moved away from. And as they move away from inflation as the pain source, you're going to get to much harsher economic pain, which is recession, crashes, insolvency, bankruptcy, things like that. And when that happens, they're always going to choose inflation because they always have, they always will, because they have that choice. Long term or short term, it's less painful to choose that. And so they always will. Now, Powell hinted at something that is should be a little bit terrifying for some people, because he started talking about if inflation does become persistent, if these high levels of inflation get entrenched in our economy and people's thinking, then inevitably that'll lead to much higher monetary policy from this, and that could lead to a recession, which would be bad for workers. So what he's hinting at the potential of happening here is if inflation gets out of control and they don't do anything to stop it, and then you start having it set into people's minds that we just have to start spending money as fast as possible because prices are going up, and no matter what I buy, I'm going to buy anything I can just to dump cash. That's when you have inflation move from being triggered and caused by monetary policy initially, moving, and then it shifts over into something that's uncontrollable just from the psychological perspective, when people start dumping the cash. And when that happens, it really does not, it's very, very difficult to get that inflation under control. Even if you just start burning the money, you just start just destroying the money as fast as possible, because you have a psychological, positively reinforcing cycle with negative consequences set in, just a downhill spiral. And you also then have recession come into play, because as they're trying to destroy the money to get a handle on that inflation, they destroy money through raising interest rates a lot, and actually destroying real digital dollars by selling assets off their balance sheet very quickly and absorbing those dollars. That takes dollars out of the economy, and so that's a real destruction of dollars, a contraction of the monetary supply. As you start to do that, you start to have real recession, real crash take place. You start to see the insolvency show up, and so you get both skyrocketing prices at the same time as just collapse in prices of like assets and unemployment and unaffordability. A lot of things. Collapse in wages and things like that. So that is not a situation that anybody who's in power wants to be presiding over. That's not something that whether you're at the Fed or whether you're a politician, that's not something that you want to see happen. And so that's why they're starting to increase their rhetoric so much right now about getting a handle on inflation, because they don't want it to tip over to that psychological part of inflation where it becomes almost impossible to basically get that toothpaste back in the bottle. So let's move over here to this is a chart of the Federal Reserve's balance sheet. So you can see the years here. Really what I want to look at is these years here from 2013, 2014, all the way through 2018 into 2019. The reason why I want to look at this is because what we're seeing actually from 2008 through to the end of 2019, we are seeing this all play out in real time at a much faster pace right now. So we saw in 2008 when the initial bailout happened, the massive expansion of their balance sheet, and then the balance sheet just continued to trickle upwards for a couple of years. And then they were finally able to get to a point where they could stop purchasing assets without the markets starting to collapse, and they just let it go sideways. And so when debt that they held got paid off, they renewed it, so they printed more money to buy more debt, and so that kept their total balance sheet pretty stable. And then right around here, when the tax cuts started to get priced into the economy, they were able to start selling assets off their balance sheet because there's more cash for the economy because of the tax cuts. And so they could take some of that cash out of circulation by selling their assets off their balance sheet, or at least letting them run off and not renewing them. So less accommodative, tighter monetary policy here, destroying money. And so they were able to do this here. What we are witnessing now, there was the big bailout in early 2020, and then a systematic increase of the balance sheet here. And so we're seeing all of this, these years from 2009 through 2014 take place within just a year and a half, basically. And then now we're going to start seeing the balance sheet move sideways for probably just a couple of months. And then they're going to start to do this, sell. And the reason why they have to compress all of this is because of inflation. Back during this time, you didn't have a lot of inflation because most of this went to increasing the base money supply, not the broad money supply. That was banks' money, not people's money. And so you didn't have all that new money getting into circulation, causing prices to go up, causing inflation fears. There are a lot of other problems, but inflation was not one of them. But most of this got into people's hands, got into people's bank accounts, got into people's paychecks, got into people's asset prices. And so most of this is now starting to cause inflation. So you're starting to see a compression. And this is what we see. When you have intervention, the problems that you sow end up causing, or they're bigger than the last problem that you stopped. And then it happens at a greater frequency, at faster paces. And so this is very normal that we're seeing this. And so we're gonna see the balance sheet drift sideways and go down as they start to sell assets, if they even get there, at a much faster pace than it happened last time from 2015 through 2019. Let's also take a look at interest rates, because this is another thing they were doing here. In 2016, again, because they had the capacity to do so with the tax cuts, they started raising interest rates here. Otherwise, they would have never been able to do that. And you notice here that in January of 2019, they stopped raising interest rates. So the question is why? You also notice here, right around the same time in September, well, they kept on selling assets and it took a little bit longer before they reversed course. September of 2019, that's when they started buying assets again. That's when they had to start reversing course. All right, let's come over here to the charts and look at what the stock market was doing that entire time. The entire time period between 2018 and 2019, the stock market basically drifted sideways and it was extremely volatile. This is the time period where the Federal Reserve was trying to normalize monetary policy. They were not buying assets. They were trying to sell assets. They were raising interest rates. And right at the end of 2018, we saw here, the market started to really crash. When did it stop crashing? Let's go back to interest rates. It stopped crashing the moment they stopped raising interest rates. Once they stopped raising interest rates, that's when the market bottomed and started to go back up. But it still didn't really do much from there. I mean, we was still moving sideways when you look at what it did all through 2018. When did it really break out? September of 2019. Remember what happened in September of 2019? Well, number one, where is it? Right here. They started dropping interest rates. Number two, right here, they started buying assets again. So they moved back to more of an accommodative, easy monetary policy. If you remember why, the repo market blew up. There was not enough cash in the system. Financial institutions needed cash. So they had to do something to start injecting more cash into the system. And lo and behold, started a massive rally in the stock market. So why am I pointing this out? Because stock market has been volatile lately, still very close to all-time highs. Most of the stocks in the major indices are not at all-time highs, but the major indices on average are still doing very well, close to all-time highs. But why am I pointing this out? Because as we do this, and as the Fed's balance sheet starts to move sideways and maybe even starts to do this, and then as the federal funds rate starts to move up, if the Federal Reserve is able to start raising interest rates here, it's not going to be long before this starts to happen. We start to get a crash. The market can't handle it. It's not strong enough. The economy is not strong enough. There's not enough real growth. It's all based on funny money, fake money injected into the economy. So when they start to pull it away, what do you think is going to happen? It's going to undo all of the growth, the fake paper wealth that was there because of the money printing in the first place. And so it is not sustainable. They cannot pull back the money train without crashing the markets. And you might say, well, why? How do you know it's going to happen so fast? Because it took a long time to happen this time. Yeah, well, take a look at this. First, look at the total amount of debt in the system right now. Absolutely preposterous. I've showed this chart a bunch of times. Non-financial corporate business debt. Look at this. Just absolutely been going up and up and up. We had a brief dip here in 2009. Rebounded way past that very quickly. If we zoom in, a brief dip here in 2020. No big deal, zoomed past that. Most over-leveraged economy in history. And you might say, okay, well, that's just total debt. When you look at, in terms of real debt, in terms of, adjusting it for inflation. Okay, well, how about this then? Total public debt as a percent of GDP. So this is as a percent of GDP. This is not a total dollar amount. And this is public debt. So this is the federal government. So we can see here that we right now are nowhere near, whether you look at the economy, the total amount of debt in the economy, or the government, we are nowhere near where we were here, where we were able to last years with no additional money being injected into the economy and then be able to last a little bit of time taking that money out of the economy. Same thing here, raising interest rates and then going a little bit of time without interest rates moving. We have a lot more debt than we had that entire time. In fact, debt was growing that entire time. And when we look at total public debt, again, we are way higher than we were all through here. And so we don't have a strong economy. This wasn't real growth. This was an expansion financed by debt, which was financed by money printing, which means all that growth is fake. It is fragile. It is unstable. And the moment you try and start pulling back on the fake money that caused that fake growth in the first place, you cause a collapse because it is all built on paper. It is a house of cards. And there's no real growth here. All this growth is just a result of the money printing. And so once they pull back on that, it is not a matter of if, it is a matter of when this starts to go south. And once it does, they'll pull another one of these. They'll start QE infinity up again. They'll buy a bunch of assets on their balance sheet. They'll drop interest rates and it won't work. They're going to have to pull out all the stops. They're going to have to do a lot more. They're going to have to do things like yield curve control, where not only are they pegging the federal funds rate down, but they're also buying debt all along the 10-year, the 20-year, the 30-year for the express purpose of keeping interest rates down when these things start to really skyrocket here and start to threaten the solvency of the federal government itself. They're going to have to reverse course and make sure that the bankruptcy and the insolvency and the deflationary death spiral does not happen, because short term that is always more painful. And if they can do something about it, regardless of the long-term consequences, they will. What to do about it? You know the drill. Buy gold, buy silver, buy Bitcoin, buy miners, buy real estate, short the dollar. These are not things that you want to hold. You don't want to own treasuries long term, because they are, like Greg Foss says, and I'm sure plenty of other people have said it, debt is return-free risk. That means that best case scenario, you lose money. Worst case scenario, you lose it all. And so invest accordingly to the signs of the times. We can open our eyes and see the rock and the hard place that the Federal Reserve and the federal government are in between. And we know they will choose the path of least resistance that will benefit themselves over everybody else. And when they're the debtors, when they're the borrowers and the corporations, to be honest, who have a lot of influence and power in the government, and they are also the most over-leveraged in history, we know which path is going to be chosen. It's going to be to benefit the borrowers and hurt the lenders. And so don't be a lender, which if you're a saver, if you have a pension, if you own any bonds, those are all forms of lending. So open your eyes, be careful, do some looking into the investments that you have, making sure that you are on the right side of monetary policy, because it'll be volatile, but long-term we know how these things play out when we just study history. As always, really appreciate you guys. Thank you so much for watching. Have a great day.